Stop scrolling. The market just exposed its weakest spot. Today you'll see the exact weak spot smart money watches, and how to take profit before the crowd gets trapped. Miss this, and you'll keep donating profits back to the market. Watch closely, because once you see this level, you can't unsee it. Let me tell you something I learned the hard way. The market does not beat the man who knows where to look. It beats the man who refuses to see what is plainly in front of him, and most traders, perhaps you included, are not losing because they cannot find a good entry. They are losing because they do not recognize when the weak spot appears. You have seen it, haven't you? Price moves in your favor. The numbers look right. The chart behaves. For a brief moment, you feel in control. And then, almost without warning, the market hesitates, turns soft, and begins to slip. That is the moment most men ignore. That is the moment professionals prepare to take their profit. I never made my big money from guessing tops or bottoms. I made it by watching behavior. The tape, or today, your chart, always tells the story if you have the patience to listen. The weak spot does not arrive with noise and fireworks. It appears quietly. Volume dries. Momentum slows. The advance begins to labor. Have you noticed how often that happens right before your winning trade gives back half its gains? The public trader sees strength and grows hopeful. The experienced trader sees the same strength and begins to ask a different question: who is still left to buy? That question alone has saved me more money than any indicator ever could. You see markets move on imbalance. When buyers are eager and plentiful, price rises easily. But when the move has traveled far and the latecomers begin chasing, the character changes. The market grows heavy. Progress requires more effort. The rallies shorten. The pullbacks deepen. That is the weak spot forming in plain sight, but only to the man trained to recognize it. Tell me honestly, how many times have you watched a strong trend and told yourself, "I'll just hold a little longer"? It feels reasonable in the moment. After all, the trend has been kind to you. But the market does not reward comfort. It rewards observation and discipline. The weak spot is not a single candle or a magic line. It is a shift in behavior. Price stops acting like it did when the move was healthy. Momentum that once surged now hesitates. Breakouts that once ran now stall. Volume that once confirmed now fades. These are not random events. They are footprints. And yet most traders ignore them. Why? Because hope is louder than evidence. When I was young in the game, I too believed profits should be squeezed until the last possible point. That belief cost me dearly. Over time, I learned something far more valuable. The market pays best to the man who takes the easy middle and leaves the dangerous edges to someone else. Do you want to know where many fortunes quietly disappear? Not at bad entries, not at terrible analysis. They disappear because traders fail to respect the moment when the market shows its first sign of weakness. Smart money does not wait for the obvious top. By the time the top is obvious, the opportunity has already passed. Instead, the professional watches for subtle clues. A trend that was clean becomes choppy. Impulses lose their sharpness. Support holds, but barely. Resistance breaks, but without follow-through. These are the market's whispers, and the trader who survives long enough learns to listen to whispers, not headlines. There is also a matter of mindset which few care to admit. Taking profit requires emotional discipline. Holding and hoping requires none. Anyone can sit and pray for more. It takes a thinking trader to say, "This move has done its work. I will take what the market has given." Have you ever noticed how difficult it feels to close a winning trade? That hesitation, that small voice saying, "What if it keeps going?" That is the very voice that drains accounts over time. The man who builds wealth in markets is not the one who catches every last tick. He is the one who repeatedly takes sound profits when the market begins to show fatigue. Wealth in trading is built through consistency of judgment, not moments of brilliance. Now, when the weak spot appears, you must already know your plan. This is not the time to begin thinking. Thinking should have been done before the trade was ever placed. Execution must be calm, almost mechanical. If the evidence says the move is losing strength, you act, not emotionally. Not fearfully, simply professionally. Watch the structure of the move. Healthy trends expand cleanly. Weakening trends overlap and struggle. Healthy momentum accelerates. Weak momentum labors. The chart always reveals the truth to the patient observer. And here is something many overlook. The weak spot often appears when the news is still bullish and the crowd is still confident. That is precisely why it is dangerous. The market turns before the story changes. It always has. So the next time your trade moves nicely into profit, do not ask only how much more you can make. Ask the better question. Is the market still strong, or is the weak spot beginning to show? Because once you train your eye to see that moment, everything about the way you manage profits begins to change. And the first sign is often quieter than you expect. The weak spot shows in behavior, not in hope. That is a lesson most traders pay for many times before it finally settles into their bones. The market does not care what you wish it would do. It does not reward optimism. It responds only to pressure. Buying pressure, selling pressure. And that pressure always leaves a footprint on the chart for the man patient enough to study it. Now let me ask you something. When you are in a winning trade, what do you usually listen to? The chart in front of you, or the quiet hope in the back of your mind that the move will continue just a little farther? Most men, if they are honest, would admit they listen to hope. And hope, in this business, is an expensive habit. Behavior is fact. Hope is opinion. When a market is strong, it behaves strongly. It advances with purpose. Pullbacks are shallow and quickly bought. Breakouts follow through without hesitation. The tape moves with a certain ease, almost like a well-oiled machine. You can feel the demand underneath it. Have you noticed how effortless a truly healthy trend looks? But the weak spot does not announce itself with a bell. It creeps in quietly. First, the rallies begin to lose their sharpness. What once pushed higher in clean strides now starts to grind. The market still moves up, yes, but it does so with more effort and less reward. That is behavior speaking. The hopeful trader says, it's just a pause. The observing trader says, something is changing. There is a world of difference between those two men. You must train yourself to study the character of the move, not just the direction. Price alone is not enough. Many trades appear strong on the surface while weakness is already forming underneath. Volume may begin to thin. Momentum may fail to expand. Breakouts may occur without conviction. These are not random quirks. They are symptoms. Think of the market as a living thing. When it is healthy, it breathes deeply and moves freely. When it is weakening, the breathing becomes shallow. The movement becomes strained. Would you ignore those signs in any other business? Yet traders do it every day. One of the most dangerous moments in trading comes when you are sitting on open profit. That is when hope becomes loudest. Your mind begins to calculate what more could be made. You start to imagine the move extending far beyond its current level. And while you are busy imagining, the market is busy changing its behavior right in front of you. Have you ever watched a trade give back profits slowly, almost politely at first? It does not collapse immediately. It simply stops rewarding you the way it did before. The push becomes weaker. The reactions become deeper. That is the weak spot forming, not dramatically, but unmistakably to the trained eye. Professionals learn to respect that shift. They do not need the market to crash to tell them something is wrong. They watch for loss of efficiency. Strong markets are efficient. Weakening markets are clumsy. Once you begin to see this, you will notice it everywhere. Another thing worth understanding is that hope tends to arrive precisely when evidence begins to fade. The public trader becomes most confident near the later stages of a move. Why? Because the move has already proven itself. It feels safe, comfortable, obvious. But the market is rarely most profitable when it feels safest. The weak spot often appears when the story still sounds bullish and the chart still looks acceptable to the untrained eye. That is why simple rule followers often struggle. They wait for obvious breakdowns. By the time the weakness becomes obvious, much of the opportunity to protect profit has already passed. Behavior changes first. Headlines change later. You must become a student of subtlety. Watch how price reacts to support. Watch how it behaves at prior highs. Watch the speed of movement. Watch the quality of pullbacks. These are the small details that separate the informed trader from the hopeful one. And let me be very clear about something. Recognizing weakness does not mean predicting disaster. It means respecting evidence. The professional trader is not trying to be right about the future. He is responding intelligently to what the market is doing now. That distinction is everything. When the weak spot appears in behavior, your job is not to argue with it, not to negotiate, not to convince yourself the trend. Continue. Your job is simply to acknowledge what the market is showing and manage your position accordingly. Profit is protected by observation, not prediction. That is a principle the market teaches slowly and often painfully. Most traders begin their journey believing the real skill lies in forecasting what price will do next. They chase indicators, opinions, and bold forecasts. They want certainty. They want to be right. But the market has a way of humbling the man who insists on prediction. Let me ask you plainly, how many times have you predicted the move correctly and still failed to keep the profit? It happens more often than most care to admit. The entry was good. The direction was right. Yet the money slipped through the fingers because the trader stopped observing and started assuming. You see, prediction focuses on the future. Observation focuses on what is happening now. Only one of those pays consistently. When a trade moves into profit, the game changes. At that moment, your job is no longer to prove your analysis was correct. Your job is to protect what the market has already given you. That requires a different mindset entirely. It requires attention, patience, and above all, respect for changing behavior. The market is never static. Strength expands and contracts. Momentum builds and fades. Volume flows and dries. The trader who watches these shifts in real time has an edge over the trader who is still married to his original prediction. Have you noticed how traders become most careless right after being proven right? It is almost human nature. The position turns green, confidence rises, and observation quietly disappears. The mind begins to say, "I knew it." And from that moment forward, the trader stops reading the chart and starts defending a belief. That is where profits begin to leak. Professional operators understand something the crowd does not. A good trade can turn into a poor hold very quickly. The market does not reward stubbornness. It rewards awareness. When behavior begins to change, even slightly, the thinking trader pays attention. Suppose a stock has been advancing cleanly. Each pullback is shallow. Each breakout shows strong follow-through. Volume supports the move. Everything behaves as it should. In such a case, the trader can sit with confidence because the evidence supports the position. But then something subtle happens. The next rally struggles. The next breakout lacks expansion. The next pullback cuts deeper than before. Nothing dramatic, just a slight loss of efficiency. This is where observation matters most. The predicting trader ignores it. The observing trader leans forward in his chair. Which one would you rather be? Markets rarely reverse in a single violent motion. More often, they weaken first. The character changes. The rhythm shifts. The move begins to labor. These are the moments that protect or destroy accounts over time. I learned long ago that the tape always tells the truth, but only to the man who listens without ego. Ego wants to be right. Observation wants to be accurate. There is a difference. Many traders hold winning positions far too long because they are still focused on where price should go. They build targets in their mind. Round numbers. Measured moves. Predictions layered on predictions. Meanwhile, the chart begins quietly signaling fatigue. Tell me, when the market starts giving you smaller rewards for the same risk, is that not information worth respecting? Protecting profit does not require perfect timing. It requires intelligent attention. You are not trying to sell the exact top. That is a fool's errand and always has been. What you are trying to do is recognize when the easy part of the move is likely behind you. There is dignity in taking a good profit when the evidence begins to weaken. There is danger in holding simply because the trade once worked well. The market is like the tide. When it flows strongly, it carries your boat with ease. But when the tide begins to turn, even slightly, progress becomes harder. The wise trader feels the change early. And here is another truth many overlook: observation keeps you flexible. Prediction makes you rigid. The rigid trader hesitates when conditions change because he is emotionally committed to an outcome. The flexible trader adjusts calmly because he is committed only to what the market is showing now. Over years of trading, that flexibility compounds into survival. Watch the quality of movement. Watch the speed. Watch the reactions at key levels. These are not small details. They are the language of the market itself. The man who studies them carefully finds himself exiting trades with money still in hand, while others are still waiting for their prediction to fully mature. Volume drying up is often the market whispering caution. It is not a shout. It is not a dramatic warning. It is subtle, almost polite. And that is precisely why most traders miss it. You must understand something early in this business. Price tells you where the market has gone, but volume tells you how much conviction was behind the move. Without conviction, even the prettiest trend can begin to wobble. Have you ever watched price inch higher while something about the move felt tired? That feeling usually has a footprint, and more often than not, that footprint is declining participation. When a move is healthy, volume tends to confirm it. Buyers step in eagerly. Breakouts expand with energy. Pullbacks occur on lighter activity because sellers are not aggressive. The market breathes naturally. But when volume begins to thin during advances, the character quietly shifts. The public trader sees price still rising and assumes strength remains intact. The experienced trader asks a different question. If this move is so strong, why is fewer money chasing it? That question alone can save a great deal of profit. Now, let me be clear. Low volume by itself does not guarantee a reversal. Markets can drift higher on lighter participation for some time, but it changes the quality of the move. It tells you the engine is no longer running at full power, and when the engine weakens, the smart operator becomes more alert. Have you noticed how strong breakouts tend to explode with activity? They attract attention. They pull in new buyers. There is urgency in the tape. But when price pushes into new territory and volume barely responds, that is often the market hinting that enthusiasm is fading. The weak spot rarely appears with a headline. It shows itself in these small imbalances first. Many traders make the mistake of focusing only on direction. Up is good, down is bad. A very simple way to think, but a very expensive one. The better question is always about quality. How is the market moving? With force or with hesitation? With participation or with indifference? Volume is the closest thing we have to seeing the crowd's commitment. When I watch a trade that has treated me well, I do not become complacent simply because price is still above my entry. I watch the behavior around the highs. I watch the energy of each push. I watch whether new ground is being taken with authority or merely drifted into. Tell me, if fewer traders are willing to buy at higher prices, what does that suggest about the sustainability of the move? This is where many give back their profits. The trend still looks acceptable. The news may still sound favorable. The chart may not have broken any obvious level, and yet the internal strength has already begun to fade. The market often weakens internally before it weakens visibly. Volume drying up during advances is one of the earliest hints. It does not demand panic. It demands attention. It tells the thinking trader to tighten his focus, to watch more closely, to prepare rather than assume. There is also a psychological trap here. When a trade has been profitable, the mind becomes biased. You begin to expect continuation. You become comfortable, and comfort dulls observation. It is in these moments that the quiet signals, like declining volume, slip past unnoticed. Professionals train themselves to become more alert when they are in profit, not less. Consider this: when volume contracts and price begins to require more effort to move the same distance, the risk-reward equation is quietly changing. The easy money portion of the move may already be behind you. That does not mean the trend is finished, but it does mean the character is evolving. And trading, at its core, is the business of reading character. Watch what happens after prolonged advances. Volume often spikes early in the move when enthusiasm is fresh. Later, as the trend matures, participation may begin to thin. The late-stage rally can look deceptively calm, almost too calm. That calmness is not always strength. Sometimes it is simply a lack of new buyers. Have you ever seen a market push to new highs and yet feels strangely quiet. That is the kind of moment that should make a trader lean forward, not relax. The goal is not to exit every time volume dips. The goal is to build awareness, to stack evidence, to recognize when the wind that was once at your back is no longer blowing as strongly. Because the trader who survives long-term is not the one who reacts to obvious breakdowns. He is the one who notices the market's whispers early enough to protect what he has already earned. Momentum slowing is the first crack in the move. It rarely happens all at once. It begins quietly, almost politely, and most traders miss it because they are too busy celebrating the direction and ignoring the speed. But in this business, speed tells you more than most people realize. Let me ask you something. When a market is truly strong, does it hesitate? Does it struggle to move forward? Of course not. Strong markets move with purpose. They expand cleanly. They cover distance with ease. You can feel the urgency in the tape. The bids step up quickly. The pullbacks are brief and shallow. But when momentum begins to slow, the character shifts. And that shift is often the earliest warning that the easy part of the move may be behind you. Most traders focus on whether price is still going up. The experienced operator watches how fast it is getting there. That difference in thinking separates the hopeful from the observant. You have probably seen it many times. A trend that once surged upward begins to grind. The candles get smaller. The pushes higher take longer. What once moved in clean impulses now creeps forward in uneven steps. Nothing looks obviously broken, yet something feels different. That feeling is not imagination. It is information. Momentum is the fuel of a move. When fuel is abundant, price travels efficiently. When fuel begins to thin, the move starts to labor. It is very much like watching a strong horse begin to tire. The direction may still be forward, but the energy is no longer the same. Have you noticed how the best trends often begin with explosive movement? There is urgency, participation, commitment. But later in the move, as more traders pile in and the early buyers begin quietly distributing, the pace often slows. Not dramatically, just enough for the trained eye to notice. This is where many traders make a costly mistake. They assume that because price has not reversed, strength must still be intact. But markets rarely send such obvious signals at the beginning of weakness. They hint first. They whisper. Slowing momentum is one of those whispers. Now understand me clearly. A single slow candle means nothing. Markets breathe. They pause. They consolidate. What matters is the change in behavior over time. When each new push covers less ground, when breakouts fail to accelerate, when reactions grow deeper, the story is changing right in front of you. The professional does not wait for the market to collapse before paying attention. He watches for loss of efficiency. Efficiency is the hallmark of strength. When it disappears, risk quietly increases. Think back to your own trades. How often have you watched a strong winner slowly lose its rhythm? At first, it barely concerns you. The trend still looks intact. Your profit is still there. So you wait, and then one day the pullback that should have been small becomes something larger. By the time the weakness becomes obvious, much of the easy profit has already evaporated. That is why momentum matters so much. It gives early information, not perfect information, but valuable information. The crowd tends to notice weakness only after price visibly rolls over. By then, professionals have often already reduced exposure. They did not act on fear. They acted on observation. There is also a psychological component here that cannot be ignored. When traders are in profit, they become emotionally invested in continuation. The slowing of momentum feels uncomfortable because it challenges the pleasant story in their mind. So what do many do? They explain it away. It's just consolidating. It's building energy. It will break out again. Sometimes that is true, but the disciplined trader does not rely on comforting narratives. He watches the evidence stack. One slow push may mean nothing. Several in a row begin to form a pattern. Patterns of behavior are the language of the market. When momentum fades, it often signals that the balance between buyers and sellers is shifting. Not dramatically at first, just enough to change the tempo. And tempo, in trading, is often an early clue to deeper changes beneath the surface. Watch how price behaves after making new highs. Does it accelerate away? or does it hesitate and churn? Watch the pullbacks. Are they still being bought aggressively, or are they beginning to stretch longer than before? These are the small details that protect profits over time. The goal is not to exit every time momentum pauses. That would be foolish and costly. The goal is to become sensitive to character change, to recognize when the smooth road begins to show cracks. Because in the market, major reversals often begin with minor slowdowns, and the trader who trains his eye to spot that first loss of speed finds himself acting from a position of calm awareness, while others are still comfortably assuming the move will continue just as it always has. The market rewards the trader who listens to subtle weakness, not the loud breakdowns, not the dramatic headlines. The real money, and the real protection of money, comes from noticing the quiet changes before they become obvious to the crowd. Most traders are trained, whether they realize it or not, to react late. They wait for confirmation that is so clear it leaves little advantage. They wait for the obvious reversal, the clean break, the moment everyone can see. But by then, the market has already moved. The opportunity to act calmly and intelligently has often passed. Let me ask you something. When the market finally looks weak to everyone, who do you think has already been selling? It is rarely the crowd. Subtle weakness appears first in behavior. It shows itself in small inefficiencies. A rally that once surged now hesitates. A breakout that once expanded now stalls. Support that once held firmly now feels soft under pressure. These are not dramatic events. They are quiet shifts in character. And character in this business is everything. The difficulty is that subtle weakness does not trigger emotion the way sharp moves do. It does not scare you. It does not demand attention. It simply sits there, quietly changing the tone of the market, while most traders remain focused on the bigger, louder picture. This is why observation must become a habit, not an occasional effort. The professional trader develops an almost uncomfortable sensitivity to small changes. He watches the quality of movement. He notices when price begins to require more effort to achieve less progress. He pays attention when momentum fails to expand where it normally would. Have you ever felt that something was slightly off in a trade, even though nothing obvious had broken yet? That feeling, when backed by chart behavior, is often the first glimpse of subtle weakness. But here is where discipline separates the seasoned operator from the hopeful participant. The hopeful trader ignores subtle weakness because it conflicts with what he wants to happen. The seasoned trader leans in closer when things stop behaving normally. Markets rarely move from strong to weak in a single violent step. They transition, they soften, they lose efficiency. The bids are still there, but they are not as eager. The breakouts still occur, but they lack follow-through. The trend still points up, but it no longer moves with authority. This is the market speaking in a low voice, and most people simply are not listening. There is also a matter of timing that must be understood. The goal is not to panic at the first sign of hesitation. That would lead to overtrading and unnecessary exits. The goal is to build awareness and prepare. Subtle weakness is information, not a command. But information, when ignored repeatedly, becomes expensive. The trader who survives and compounds capital over years learns to respect these early signals. He may not exit immediately, but he adjusts his posture. He tightens risk. He becomes less aggressive. He stops assuming the trend will behave the way it did earlier. Flexibility is born from observation. The rigid trader, on the other hand, often finds himself surprised. He was watching the big picture while the small details were quietly changing underneath. By the time the weakness becomes obvious, he is reacting emotionally instead of acting deliberately. Tell me, which position would you rather be in when the market finally makes its sharper move? Subtle weakness often appears when confidence is highest. That is one of the market's oldest habits. When the public feels safest, the internal structure is often already shifting. Not always, but often enough that the wise trader pays attention. Watch how price behaves at prior highs. Watch the response after strong news. Watch the depth of pullbacks and the speed of recoveries. These small clues form a mosaic. No single piece tells the full story, but together they reveal the market's true condition. And make no mistake, Protecting capital is what allows wealth to compound. Big wins are memorable, but consistent protection of open profit is what builds staying power. The trader who repeatedly gives back gains because he ignored subtle weakness finds himself running hard just to stay in place. This business is not about catching every last point. It is about positioning yourself intelligently as conditions evolve. The market is always communicating, always leaving footprints, always revealing its level of effort and conviction to the trained eye. But it does so quietly, without ceremony, without urgency. Wealth comes from consistent exits, not perfect tops. That is a truth the market teaches slowly and often expensively. Most traders begin with the wrong ambition. They want the exact high, the precise turning point, the clean victory of saying, "I sold the top." It sounds impressive. It feels skillful.